4.9 forecast. For my next guest, Wang is with us here on set, chief economist at Hang Seng Bank. China, 4.9%, upside risks to that figure?
Well, it's hard to be too optimistic at this point, especially with the ugly data coming out for Q1. And the 4.9 is towards the lower end of the government target range. And we think there's a chance that we might have to lower this forecast, given how difficult it is for a lot of projects to roll out in China right now.
Where is the inflation right now, I should say? With that inflation print, it seems like we're still not seeing any signs of domestic demand coming back in a big way.
Yeah, and if we're talking about goods market, there's really no sign of any prices going up. Maybe from the second quarter on, the pork price might tick up because the supply-demand starts to shift. The supply of the pigs are starting to decline from earlier this year. And then when it comes to the services prices, tourism, transportation, entertainment, they do have a tendency to go up in the first quarter. Especially we have a longer holiday season this time in April, and that has encouraged a lot of people to get out and spend more money. And slightly, we see this kind of improvement in consumption. So that's one slight source of this small inflation. Yeah.
And you're normally based in Shanghai, and I'm wondering what the mindset of consumers are as it pertains to inflation. Are people thinking prices are going to fall? Because that's a bad mindset to get into for consumers. Well,
if you're living in China, people have this perception now that inflation is nowhere to be found. Probably it's going to be a permanent phenomenon that China will be stuck in this sort of low inflation environment. And a big reason for that is when you look at different industries, there's still a trade war going on in almost all the consumer goods sector. And the factory inflation has been going down and down for over a year now. For Chinese companies, they are under huge pressure to actually adjusting down their prices instead of adjusting up. And for Chinese consumers, they're still quite conservative about where the economy is going. With the housing market down, and people actually still have very high tendency to save up more.
So that brings me to this overcapacity conversation that's taking place. Janet Yellen was in China recently, and is there an overcapacity in Chinese industry right now?
From an economic perspective, you have to define overcapacity because at the right
inflation.
Price, inflation, yeah. Exactly. So at the right price, you can basically sell anything. But before COVID started, China was going through this phase of overinvestment in the manufacturing industry. So it is true that across the board, it's not just only within those green industries like the emerging industries, new energy, new material, but also in traditional industries like cement, glass, you name it. Almost every single industrial sector is going through this overinvestment. And now we see a lot of idle capacity. Part of it was because there is a lack of demand for housing and construction. But the other part is really coming from this huge effort from the government to help China to gain more advantage in its green technology and green industry. So as a result, we do see this lack of momentum in the industry to curb back its investment in those industries. But I think the bottleneck still is in the demand side. So if the global market is still open to China, then we won't have a long-term overcapacity problem. But now it just seems that not just Americans, but also the Europeans start to be very concerned that China's cheap products, including the green products, will wipe out some of their industry.